Hi everyone, Jeremy Reynolds here, Alpha Money Coach. First of all, I want to say thank you to all those people who have been attending the daily home loan and mortgage coaching which I host each and every day at 1 p.m. to 1:15 p.m. Central Standard Time. It's 15 minutes of absolute brilliance, not that I'm tooting my own horn, but this is the feedback I'm getting from helping many people with their home loans, understanding basic and sometimes complex different things, but also looking at current events as well, but really sifting through the hoo-ha, sifting through all of the rah-rah that you hear in the media and getting to the key issues. And because, truth be told, you're actually fed a lot of and provided with a lot of the problems that are happening in the economy, with home loans, in the banking industries, APRA, ASIC, just to name a few. But my concern is, in my business with all of my clients, is people need solutions to the problem. So first of all, they need to get the context, understand what the actual problems are, but they need solutions. So I need to clarify that one of the differences between myself and the team at Alpha Finance Solutions is, yeah, we're going to make sure we talk about the problem. We're not going to ignore the problem, because that's an issue in itself that many people will go, well, let's put the rose-coloured glass on, let's ignore it and deviate away from the problem, and then that problem comes and bites the person with their loan, their financial situation in 6, 12, 18 months or within the next few years anyway. So first of all, I'm always going to make a point to identify what the problems are or potential problems that you could face are. But I'm in the business of solving problems. So I'm here to first of all educate you on the problems, so you've got an awareness piece about the problem itself, so you can go in with eyes wide open. And then second of all, provide some solutions. Now in these trainings, I do provide education on general solutions, but I also want to make it really clear that the best thing to do is to get that base of knowledge and then make contact with myself or my team. And that way we can look at your circumstances on an individual basis and provide some personalised solutions for those in the fields of mortgage broking, taxation, accounting, insurance, superannuation, or real estate for that matter, just to name a few. So today, what I'm doing in this video today, there was an amazing response from the training yesterday, the home loan and mortgage coaching, and many people asked, they said, well, that was really good. Can you touch on those things again? Because I want to revisit the material. I want to watch it again or hear it again, because 15 minutes I can cover a lot, especially when I'm talking at quite a fast pace and getting excited. So what I want to talk about is interest-only loans. And you go, well, okay, interest-only loans, that sounds pretty basic. What have you got to talk about? First of all, interest-only loans have been the subject in many headlines in newspapers across the country, very credible news sources as well, online. Many of the online news sources as well, television, as well as social media, with concerns regarding individuals, families, couples, taking out interest-only loans. So let's talk about this right this minute. Is there anything wrong with an interest-only loan? Not the interest loan itself, but there can be some many dangers if it's not suited to your individual needs. So let me paint a picture, and I'll give you a few very simple examples to help build why different regulators are concerned. So first of all, we've got two major regulators. What does a regulator mean? They're watchdogs. They're those that monitor, regulate, make sure different industries and different entities not only play by the rules, but make sure that there's consumer confidence with them, make sure that they're following the legislation that they've been given delegated authority to monitor. So who have we got? We've got ASIC, the Australian Securities and Investment Commission. They monitor mortgage brokers, they monitor small business, superannuation and insurance. So brokers are held accountable to the standards of ASIC. And we've also got APRA, the Australian Prudential Regulatory Authority. They do the same things, but for the banking industry and the banks themselves. Now, largely, though they're independent, there may be the similar concerns from APRA and ASIC with what's happening with interest-only loans. So let's talk about it. We have Mr. and Mrs. Client looking at buying an investment property. With the investment property they're looking at buying, they meet with Mr. Broker and they look at their cash flow. We call this serviceability in our industry, but it's your cash flow, your future cash flow to pay off that debt. They realise, and the broker goes, oh, you know, you can't actually successfully afford to pay for this loan, okay? And they leave it there. They're transactional broker. They care about writing the deal, and they think the best thing they can do for any client is just get them the loan. Warning, warning, but let's move on. So they suggest, why don't you just go interest only, because you can't afford to pay the principal off on the loan. In other words, this is a way that you can pay less money for your loan today. And if we do interest only, it can be, you can actually afford to make your repayments. Okay, the consumer who isn't expected to be the expert, well, the broker must know what they're doing. That sounds like a really good idea. And I'm going to write it up and say that there's some sort of, negative gearing strategy there. He's not an accountant or a tax agent. You can't really even say that. But the consumer, Mr. and Mrs. Client, say, okay, so we can get our investment property. That's really good. We couldn't afford it. Excellent. Now I'm going to talk to you about the compounded issues. So keeping in mind, the first issue that that was made clear is that it's highly dangerous that there should ever be an individual or a couple should be put into a loan that they can't afford or struggle to make the repayments, or they can't make the payments with buffers in place as well. So it should never be a reason to be put in an interest-only loan for cash flow reasons. We can't afford this. So let's clarify this then. All interest-only loans are for a term. So you can't get an interest-only loan forever, because a home loan needs to be amortised. Amortised, that's the big word for the day, amortisation. Don't expect many of you use that, I've heard it before, but what that means is if you take out a loan for a term, and typically it's 25 to 30 years, the rules stipulate that that has to be paid off without question within that period. So if it's a 30-year term, no matter what happens internal to that, the loan must be, the principal and interest component must decrease over time. So at the end of the 30 years, the loan's paid off. Because that's what we should be looking at, is getting loans paid off, not just getting loans. Otherwise, if there was no end date, it wouldn't be a loan. It would actually be in effect like a credit card, which you're not doing here. So we've got this client and they get the interest-only loan. How long are we going to do it for? That people, in general sense, get it done for the maximum term, which is usually 5 years. So 5 years go by. They've made their payments, not a problem. After the 5 years, principal and interest kicks in at the current standard variable rate. Now, I'm going to go through the layered issues that are associated here. So, the first issue associated with it is that now they go, we remember Mr. and Mrs. Client couldn't afford to pay principal and interest. Now, 5 years is a long time. They forgot that they couldn't afford it, and that's the reason. So when it reverts, there's a knee-jerk. Their income hasn't gone up. Maybe their expenses have gone up. Maybe they've had a few kids in that time as well. So now their expenses are higher. And they've got this debt, and it's difficult to make the repayments because they're paying the principal and the interest component of the loan off right now. This can create huge dangers and difficulties for that client, and huge stresses for them as well. Meanwhile, that broker's off doing anything. They probably can't even remember that client. They don't remember their circumstances, and they really don't remember the reason for giving them the interest-only loan, because it was so long ago in their book, and they didn't look beyond the initial period. They thought 5 years is a long time, let them worry about themselves. I also mentioned, though, that it's reverted and it's gone to the standard variable rate. What does that mean? Now, right now, today, we've got exceptionally low interest rates based on a historical basis. So, yeah, with slight deviation, let's say, but within the last period, we're at all-time lows. Loans have never been as cheap. And you might say, well, 6 to 12 months ago, there were some that weren't. But let's say, generally speaking, loans are at an all-time low. So if you're struggling to pay the principal and interest off at an all-time low, what's going to happen if and when the interest rates go up? So this client is now faced with, yep, you've got to pay the principal, which you can't afford. But second of all, you're going to have to pay the principal and interest at a higher interest rate that you had when you took out the loan. Compounders. So now the payments have gone up even more. So first of all, we've got number one, we've got that they have to now pay the principal as well. They shouldn't have taken out the loan if they couldn't afford it, but they've got to pay the principal now. Second of all, they're paying it back at a higher interest rate than when they took out the loan. But now here's the key issue, coming to that amortisation. I mentioned earlier, and I sort of put it on ice for a moment, that it's for a fixed term, the loan. It's 30 years. So let's tackle this. Mr. and Mrs. Client didn't pay off any principal on their loan for 5 years. This doesn't mean that things are going to remain the same. What it means is now, Mr. and Mrs. Client, do you realise that you've got these two issues? You've got to pay the principal now as well, at a high interest rate potentially, but you've actually got to play catch up now. The principal that wasn't paid off in those first 5 years now has to be paid off for the remaining term, for the remaining 25 years, meaning you've now got another component that makes the loan repayments be even higher. Therefore, you've got three key issues, all of them creating huge issues for clients in affording their loan. Now, a lot of the banks, let's just say that their books are too heavy on investment, and these things are concerns with having investment loans with interest-only components. So they're actually looking at this and saying, we've got to be really careful who we take on, but also the broker's got to take responsibility. Now, what I suggest is the best way to read and look at these problems and help solve them is tackle them before they're raised. So not internal to the loan, that's a component, but let's actually mitigate, reduce, manage, reduce any particular issues, problems, concerns that could occur in the future before the loan's taken out. So with this particular client set, the issue was simple. Servicing the loan or having enough cash flow to pay off the loan. So there's some simple things, yet slightly outside of mortgage broking, that a full financial services organisation like Alpha Financial Services, working in conjunction with Fab Tax, can and will help with each and every time. Number one, looking at the budget of the individuals and the couple. And I say the individuals because often couples don't understand completely the spending habits of each other, regardless of how intimate and how long they've been together. So looking at and painting a picture of an itemised cash flow, looking at the fixed expenses as well as the discretionary spend, you would be amazed that purely through this exercise and working with one of the Fab team, we can identify some particular expenses that could be reduced or removed to increase your cash flow to be able to make repayments on that loan, which is really important. Second of all, let's look at the elephant in the room, which is often forgotten about with servicing a loan. What's the easiest way to reduce your loan term and to reduce your payments on a loan? People say a lot of interesting things internal to the loan. I'm going to talk about this. It's to actually get a smaller loan. So it's a bit of a head scratcher, which greedy mortgage brokers say, well, I want the client to borrow the most amount. Why? Because they might get paid the most. But we work with accountants and taxations who are impartial to this, as they're paid on a fee basis. Therefore, they can help them work out what they should and what the maximum they can actually borrow is within their budget, and set some limitations in conjunction with their cash flow budget. But let's look at this from a property basis as well. Mr. and Mrs. Client, what property are you looking at buying? We want this property. It's the 5-bedroom, 2-storey, 2.5 bathroom, double garage, and it's our first home. So the concern I see there is many borrowers are trying to get the big house, the elaborate house, the huge house as their first. Actually get a smaller house to begin with. Why do you need that big house? We'll make the effort to actually communicate with you and your needs And your needs both financially as the balance point here, but also looking at your value set, looking at your personal reasons why you want the big house. Perhaps it's getting a smaller property, or working like ourselves, working with exceptional real estate agents to get a similar property in a nearby suburb for a reduced price. Because if you understand the markets, which the real estate agents we work with do, you can actually look at it and say, well, this is the criteria we're looking for. And did you know that the median house price in the suburb adjacent to the one that you're looking at buying is 20, 30k less than what you're paying there? Because you can often pay for a name. Or are there any particular features that you'd be willing to forego to afford the loan? In other words, let us have the logical standpoint here that we can maximise what you'd actually like and need, but also not that it would put it in danger, because it doesn't matter about acquiring the property of your dreams on an interest-only basis if you're going to lose it when you can't maintain your payments. Now let's look at another big issue. So we can save you money, we can make sure we're actually reducing the amount you're borrowing for one component through the choice of the property you're buying, where you're buying it, or the price you're offering those people as well. Go in with a budget when you're buying the property. Don't think that you need to go to the maximum amount of borrowing capacity there. But now let's tackle some slightly other issues internal to this as well. So let's go back to the problems, which will be a bit scary. What if that particular property, that investment property, was now bought? It wasn't bought at the best price. It was bought at an inflated price in an area you didn't know well, interstate, from a property investment group. So you didn't even see the ground. You didn't see the ground broken. You didn't see the similar properties. You got some information from them. Now, and what's happened within that suburb, based on the influx of investors and properties and other issues and the market, and the saturation, that the property hasn't, at that 5-year point, what if it hasn't increased in value? What if in fact it's actually declined in value? And you haven't paid off any of the principal? This can create a huge danger, and I'm looking at the extreme circumstances here, of a property now becoming in negative equity, which is very scary stuff. This means that your property is now valued at less than what you owe. So the debt on the property is higher than the actual value of the property, creating a further element of danger. So how do we solve all these problems? First of all, it's making sure that you're working with the alpha team who can project manage your entire financial needs. So I've started talking about interest-only loans, but there's more components to this. A broker putting on their blinkers and just worrying about getting you the loan, they're transactional. This isn't retail. This is your home. This is your livelihood. This is your financial future I'm talking about. So we'll make sure that we get all of the right players involved, including the broker, working with FAB, tax and accountants to formulate that budget. And on a side note, not that I'm talking about in this video, make sure the structures are right in place for that. Working with local real estate agents instead of property investment groups to make sure that you're actually getting fantastic knowledge and buying the right property for your needs and your budget. And also, in the end of the day, not just getting a loan, but paying off your loan, creating a sound financial future for yourself and your family, so then you can achieve your hopes and dreams and your goals sooner than you thought was possible. I'm Jeremy Reynolds. Please leave your comments below.